Good evening, everybody. Okay, we've got some cameras coming online.
Hi, everyone. Welcome.
G'day, g'day. We have Mel, we have Sister Mel, we have David, we have Anne, we have Lana, we have Lisa, Kirsten. Good to see you, mate. Stacey, Peter.
It's very nice to see some faces. Thank
It
you to those
is.
who can, Blake's here.
Yeah,
Thanks to those who can put their cameras on. That's awesome. It's always nice to see who you're talking to.
100%.
Massive welcome to everybody. Thank you so much for being here. We're really excited that we could spend some time going over these really important issues. We'd just like to say a big shout out and thank you to George for joining us tonight and giving his time to be able to answer some of these questions that I know a lot of people are feeling, yeah, a lot of hesitation and worry about. I'm just going to hand over to Josh to tell you a bit more about George, and then
So,
we'll get into it.
yeah, guys. So, g'day, good evening. I hope you're all, you've settled down after a hard day's work, whether you got a cup of tea or a cup of coffee or even a wine or something like that, to be able to just sit back and enjoy the ride. So we have George Morrice on tonight, from Prime Partners Accounting. He has themed in our podcast, Hard Ground. If you haven't listened or watched that, go check it out on YouTube, or you can get it on Spotify as well. That's Hard Ground with Josh and Steph. So, guys, really, what we're here tonight to do is really sort of sit and ask questions and listen around the topic of the budget, how that's going to impact our operations, what some of these things mean, what are some of the hazy things, and get some clarity on what this could really do impact-wise on some of our businesses. So we're going to have some questions. We're going to ask for some interactions. Basically, we're going to keep this whole thing's recorded, and then afterwards, guys, when we do have a bit of a question time, we're going to be sort of like, throw your hands up. Then we'll get a bit of an introduction, who you are, where you're from, what you do, and then, what's some of the questions that you'd like to ask. But without further ado, we're going to hand it over to Mr. George Morris. Um, so, George, over to
Take
you,
it
mate.
away.
Yeah. Hello, everybody. How are we all doing? So, thanks for having me on, Josh, Steph. This is much easier than looking after and feeding the kids tonight. So I thought it was a good way to get out of that was come and chat with you guys. 2-second background about myself. Grew up on a cattle farm near Coolah, New South Wales, for anybody who knows that. Had a company in Sydney, now live sort of out near Orange and come back into Sydney. So I sort of straddle between having a bunch of rural clients and also having a city sort of based accounting firm. The budget has ruined my week. As you can imagine, I have had nothing but phone calls this week from my clients, how it's impacting them, what the changes are going to mean for them, and where we're going. So when I was chatting with Josh and Steph, I said, well, happy to jump on, just run through the high level. Before we jump into any sort of detail, the key thing to take away from tonight is this is proposed budget, not legislation. Okay, we've seen in the last few days everybody running around like crazy lobbying the government. All the memes of Albo is now 47% owner in my startup, going nuts. So at the end of this, be very careful would be my starting point on this is be very careful. Nothing is in law. They looks like they're going to give time to change. They're talking about a 2-year period to sort of roll over structures and do different things. So today let's talk about what they've said, not necessarily what the end result will be. I think there's a good chance that once legislation's passed, we do this again. So I just want to start on that. Before we got in, has anybody got anything burning they want to cover off on tonight? Something that if I missed, they'd be really upset.
Okay, Peter, we have you. Just going to get you to unmute.
Hi, how you going?
Good, Peter. How are you tonight?
Good, thank you. I'm from Jocelyn, South Australia, and my question is that my husband and I have separate jobs. So my husband's a police officer, and I manage our farm, but we lease our land out. So our question is that how does that affect us? Because in 3 to 4 years' time, we're looking to sell the property. And we're a bit concerned. Our main concern is what are the government going to take from us?
Yeah. Okay.
Mm.
Okay. So there's a couple of things there around the leasing, the type of income it is, whether it's considered prime production. Peter, what structure is it held in your personal names?
It's in a family trust.
Okay. So I don't have the answer to one thing yet. Basically, they have come out. So a lot of people probably heard about the 30% minimum tax that they're going to put onto the trusts.
Yeah.
They've been very clear that agriculture prime production income has an exemption from that.
Right.
Okay. So whether leasing, they haven't been clear yet, whether leasing will be considered prime production income compared to those sorts of things. So I can't give you an answer on that part tonight.
Yes.
That wasn't really a question though, but just sort of what you need to know.
Yeah.
The other thing is the CGT.
Yes.
Based on the legislation that they're proposing, not that has been passed, you will still be eligible for the small business CGT concessions. Nothing has been touched there.
Okay.
But depending on your situation, whether you're passing the asset tests, whether you're, it's considered an active asset, how long you've held it, whatever it was before, you're not going to be hit any worse from that point of view. Now, let's say you're in a world where you are not eligible for the small business concessions.
Mm-hmm.
The budget night date last week,
Mm-hmm.
you will have exactly the same treatment as you would have before. Up to that date, you'll get a 50% CGT discount
Okay.
on that. They're giving us options in the proposal of, do we need to get a valuation as at that date, or we can do an apportionment.
All right.
Okay. That's important. It mightn't be important in your situation, but in some cases, we've got a client we were dealing with last week. They have, a $6 million farm, but it's on the edge of a town. They have an option with the developer that moves it from being $6 million to $30 million value.
Okay.
For them, if they go by a valuation as at the date, the value will probably have to go on the $6 million date. 2 years later, they sell it for 30, they would have a huge tax bill under the new system.
That's what we're concerned about.
Yeah. So look, depending on your time frame, it's not going to be bad. So from up to budget date, it's exactly the same. You get the 50% discount.
Yeah, because we just get the capital gains tax just frightens absolutely terrifies us. I mean, this is a it might not happen, but we because of our land and where the position is of our land, like it's a third generation farm.
Yeah.
And we get offers, phone calls all the time to people to buy the land. But if we're not going to sell it to anybody, if we're not going to walk out comfortable, and that was our main concern, and everything's in a trust, and the trust pays for my children to go to private school, it pays for all these things, and it just seems like that we're going to be worse off, and I'm a bit naive about it and not very well educated, so that's what I
so you most likely are going to be worse off for the gain from budget night forwards.
Okay.
Okay, so from budget night forwards, you'll come under the new system. The new system is basically, I'm going to use made up figures. It was worth $5 million. You sell it in 5 years' time for $7 million.
Mm-hmm.
You've got a gain there of $2 million. Under the old system, it would have halved and you would have had a gain of $1 million, and that would have been taxed at your marginal rates.
Yes, that's right. That's correct. I was that one, but
under the new system, so you've got a $2 million gain. You have a bit of inflation for those 5 years. So now you've got a $1.8 million gain or a $1.7 million gain.
Okay.
So the actual amount you're getting taxed on is significantly higher there.
Okay, terrific. Thank you so much. You've answered my question.
Yeah. Yep.
Thank you so much, Peter. Thanks for that.
So that's, and I mean, I'll jump on a few of those points and just expand them out a little bit more. So the capital gains tax is obviously one of the biggest things in there. They have decided to hit every asset class, not just residential, which is why it's fallen into farming, the warehouses, the shares, everything else. So that was actually, I want to start with one other thing before we get into this to give you context of the budget. The budget makes very little sense from someone who understands tax. No matter what their policies they're trying to achieve here, the way they're doing it is like you gave a 16-year-old a basics of how Australian tax works and tried to get them to figure it out. The amount of loopholes I've already seen people coming up with, you can't negatively gear an investment property, but you could probably buy some shares in a company you own with debt and then go buy an investment property. And you haven't bought an investment property with debt. You've bought shares with debt. Now you can actually negatively gear it. So the cheeky accountants in Sydney are already getting into that, right? They're already figuring out the ways around it. They have really not thought this through. And I think they're really starting to think about whether the policy was right or wrong. I'm not making a comment, but the way they've tried to go around it, they've completely messed up. So I do want to say I think there's going to be a lot of changes between now and when it's legislated. So jumping back to the capital gains tax. The capital gains tax is massive. for a couple of reasons, and from farmers, including my family farm. It has brought pre-CGT assets into the taxing system for the first time. Okay. Up until budget night, anything that was bought pre-capital gains tax, 86, coming in, it was exempt. Now, it is from budget night going to be in and is going to be taxable. So if anybody who had a capital gain asset that they've held since before 86, it is now into the system. All right. That was a bit of a kick that I didn't see coming, to be honest. The rest of it, it really is going to make you worse off when you sell. Now, it's only when you sell, that is an important thing, but you are going to be worse off under these proposed laws. Does anybody have any other questions specifically about the capital gains tax? Yep.
Yes, I've got a question.
Yep.
We have an investment property that's separate to our farm, and I was wondering if sometime in the future we wanted to sell that rental house, which is actually what our first house was before we came back to the farm, can we use the money from that house and pour it into making our farm better with infrastructure and stuff, and use the profits from that sale to improve our farm and sort of offset that tax?
To a degree. So first thing is it's a residential property, I'm assuming you're talking about?
Yes.
Yeah. So it's going to be subject to the same thing we were talking to Peter about before. Up until the day of budget, it's going to be taxed under the old system. From that date forward, it's going to be taxed under the new CGT system. So in your, and sorry, I should have asked, how's that held?
The house, yeah, it's in joint names, and then the farm's in a trust.
Okay, no. No is the simple answer to can you offset that if your farm's in a trust? Because if you create any losses through the farm, that's going to be quarantined to the trust, and the capital gain's going to be in your personal name.
Okay.
Yeah. So you sell that at any point, you're going to have capital gains tax payable on that. Interesting thing, and I think this is for other people as well, anybody else that has an off-farm asset like that, it can be negatively geared still. I'm not sure if your particular one is, but it can still be negative geared. A bunch of my clients who have that situation are going to their banks or going to, we have brokers they quite often use, going to the brokers and changing those loans to interest only. The reason they're doing that is as soon as that loan's paid down, you no longer can negatively gear that property. You're out of the negative gearing system again. So if you do have any property that has debt, one thing to consider is whether you need to negative gear it or not.
Well, this particular property is almost paid off, and up until budget night, we were sort of thinking, well, let's use the rental income from that, get another block of land and start again. So that, because we're really trying to have some sort of income that's separate from the farm, because we're in drought at the minute, and it's really nice to have a separate stream of income. And then I just thought to myself, why would we go and do that when we're going to get trying to think of the right way to put it without
You're going to get hit with such a hard tax on it.
Yeah, so I was going to say kicked into twins.
Yeah. Yeah, that makes sense. So you're right. You would have started to getting into a tax position on it anyway, simply due to the way you're structured now. You would be paying a bit of tax on that. What some people are doing, I'm not a financial advisor, so definitely not giving advice here. Some people in your situation I've seen have gone and drawn money against the house, not for the house, but drawn money against the house and made other investments that weren't property. So people are now more looking into your ETFs, your managed funds, your shares, and some of those being dividend paying, because you're talking about having an off-farm income. You can still claim the negative gearing against anything that's not residential property. So you could draw against that, buy another farm. You could draw against that, buy a warehouse. You could draw against that, buy shares, buy ETFs, buy, those sorts of things. So if you were thinking about looking at things outside of property, you can still get your negative gearing. And because you've got that property there as an asset, you can borrow against it.
Yeah.
So that's one way people are looking at it.
Okay. Thank you.
Anybody else got questions on this? No? Okay. I'll jump onto there was actually minor wins in the budget as well. Like, we're not going to be jumping over. But for farmers in particular, I think the 7.5 billion that they've put aside for the fuel and fertiliser stability, it's not going to bring prices down. Let's be honest about that. They're going out to industry and trying to get them to store it all, but it is going to give you a little bit more security. So I actually think that for farmers is a particular win, that more shocks happen, you are a little bit more protected. They're talking about, I think, 250,000 tonnes of urea, and they were 3.2 billion of a fuel reserves. So at least it means maybe if we have another shock, there's a little bit less stress that comes through. Is it really going to change the profitability of your farm? No, it's not going to help with that. But it is going to at least make your supply a little more secure. Anybody here operate their farm through a company structure?
Guys, if you want to just take yourself off mute. Phoebe, I said that you're off mute. Yeah, by all means, just go
Yeah,
ahead and
George,
We do as well.
And I do
Kirsty.
as well.
Yeah. So an interesting little thing in the budget that I think is potentially a win is they brought in, and they did this very temporarily in COVID, loss carryback rules. So, and 2-year loss carryback. So that's looking at, okay, we had a good year, we made some money, we paid some tax. Next year, you hit a drought, something went wrong, you made a loss, bought a heap of fertiliser, bought a new farm and spent a lot on fencing and fertiliser, whatever it was, and you get into a loss position, you can take, or the accountant can take that loss, go back and apply it against the year before where you paid tax, and you can go and actually claim that tax you paid back. Right? That's actually a pretty good thing. I'm a big advocate of that as a change. We're trying to get to what the real position you've made over a period is. Limiting it down to a year really isn't that fair. So they've done a pretty good change in that. I didn't mind that. So that loss carryback, I think, is a good change they brought in. The other thing they've done at the moment is the fuel excise being halved. That is obviously aimed at keeping you going with diesel as the prices go up. I think it was 111 a barrel today or somewhere around there. So it's still sitting super high compared to the sort of 68, 70 it was before we rolled into this. The thing to be careful, just from my viewpoint with that, is whoever's doing your BAS, be really careful around the calculations. They have changed the numbers of how you get your fuel tax credits. So just be really careful in that, because we want to get as much money back as possible and not screw that up. Yeah, so that's one thing we're here very careful. We had a full training on it with all the stuff just to make sure they're across it before the next set of BASs hit, because it is huge.
Sorry, can you go into that a little bit more, those changes?
Yeah, absolutely. So there was 2 parts to it. There was the heavy vehicle road toll that had been dropped, so they're helping get the fertilizer, get the fuel and things to you for 3 months. But the government obviously charges a huge amount of tax on diesel. And what they've done over this period is they've halved it. So basically, they're trying to bring the real price to farmers, transport companies, everybody down, because I don't know what it is, to be honest, but I think it's like 30-40% of what you pay at the bowser goes straight in tax. So they've halved that, which allows the price of the bowser to be cheaper by, say, 10-15%. As part of that, they've gone and changed the fuel tax credits rebate system, so the rates are different, so that when you do the calculations, they did change over time anyway, but they've changed them as part of that cutting the credits. They've cut that. So when you calculate as a farmer, we say we use this much diesel this quarter, and we create a rebate that we can get back, which is basically the government's way forever of saying, look, we charge a lot in tax on diesel. Because you're using it for prime production, we're going to give a little bit back. But because they're already giving some back on one hand, which is the fuel tax excise cut, they've also changed the rebates amount for when you lodge your BASs.
That's really just a matter of keeping an eye on those rebate amounts via their website, sort of thing. Because
Exactly.
I'm
Yep.
looking at that today, and they've got a 5-month period, and then they've got a little 1-month period, and then they've got a 3-month period, and they change each time.
Exactly, and it's really easy to mess that up at the moment because they're changing it so regularly. It's like trying to drive over the Blue Mountains where you're going 60, 70, 60, 50, 80. Like, you've got to be on your toes or you get pulled over.
I tend to lay mine out in a spreadsheet, all the entries in that, so I can keep a good track of it. But
Yeah.
cool.
Yeah, exactly. So that's what that is. That was a pretty major one. The other thing that I thought really sucked out of the budget for rural is the biosecurity cuts. So there was some sort of exemptions in there that were aimed at getting fertilizer and things in quicker. don't necessarily mind that. You know, there is maybe a minor risk to it, but I mean, urea is pretty inhospitable, so I'm not as worried about that. But they have gone, and I had the figures written down, but they're cutting the biosecurity funding for Australia by like 26% in year 1, 57% in year 2, and I think it was 80, 86 or somewhere percent in year 3. So they are cutting all the funding out. That was the feral pigs. That was all the sort of biosecurity stuff they're doing. They're removing all the funding for that as part of their government saving package.
So basically, in that, George, they're basically just like robbing Peter to pay Paul in one way. Like, so all the efforts being made to try and keep stock routes clear of weeds and all that kind of stuff, they're just going to gut that.
Yeah.
So you're just not going to see that kind of those stringent controls. Or they've been sort of degrading, I think, for years now. But
Yeah.
you
Yeah,
tighten
and
the
it's going to
Hudson
get
Bay, all
worse.
that kind of stuff's going to go berserk.
I remember it's mid to low 80s. So let's say between 83, 84, somewhere there, I remember the percentage was, that by 28, 29, financial year 28, 29, they're going to have cut it by like 83 to 84% of their current funding. Right? The side of the roads are already covered in St. John's Wort. Like, you know, they are not winning as it is, and they've now cut an extra 80-something% off. So that was another sort of shitty thing I saw out of that. So all in all, you know, not a great budget for anybody in Australia. You know, what they were giving to people who are employees was pretty minimal. They attacked everything, not just property. I can sort of, the logic they try and put, whoever's just Stacey, fire ants, and they cut. There's a jumping green ant or something else. They cut direct funding to that program as well, and the carp eradication program. So, you know, it wasn't a great budget for anybody, this one, to be honest. They are trying to attack property, not rural property, but residential property, and their logic for that was sound. A lot of Australian money goes into residential property, and it was not hard-working capital. You'd buy a house, you'd sit on it for 30, 40 years, and you'd go. And they're trying to aim that more into businesses. But the way they approached it with this policy is just completely missed the mark. Right? They're trying to create some innovation. They're trying to create wage growth so that people can actually afford to live in Australia. And they just completely missed the mark on this. So not to be the doomer and gloomer, what's it mean for you? Okay, so it depends on your structure. So let's ignore the capital gains tax now because that's when you sell. Let's have a look at it. So you're sitting in a sole trader or a partnership. What does this budget mean for you? Okay, probably not a hell of a lot, which is good. Like cost of living is going to go up. You're not going to be hit by the minimum tax distributions. Your losses are all already able to be used. So for you, you know, in all honesty, other than the capital gains tax, which does suck, you're okay. Now, if you're in a trust, you've got a couple of impacts. You've got, if you ever distributed from it to a bucket company, that is 100% out now. That is a 60% tax rate. So some people would make money in a trust, and for legitimate tax protection reasons, so asset protection reasons, I'll come back, James, on the Testamentary trust. They would send it down to a company that was owned by a trust, so that if they got sued personally, they didn't own those assets. So if they want to take a risk in business or something, they would protect themselves. That's gone. They've completely killed that. The 60% tax is ridiculous. We are not a communist country, and I can't understand how they pushed it that hard. If you are a trust that is distributing out to some other family members that were on low incomes, well, now you have to have a minimum 30% tax rate. To get to an average 30% tax rate, you're sitting at around 180 grand you have to distribute to that person. So if you formally distributed to someone, you know, to a spouse, 90 grand, maybe the kids got a bit older, gave them 50 grand, your tax rate on that has significantly jumped. So if you're sitting in a trust structure, that is the year-to-year sort of impact that this budget's going to have on you. The last thing is a company. For a company, you've got the CGT implication to a degree, but you don't get a CGT discount anyway in a company historically. So for companies, you're probably not as impacted anyway. The next thing to discuss, anybody else got questions on that before I jump on?
George, if I was to if my father was to transfer a property into my name
Mhm.
at the moment, before these changes come into effect, would that attract the CDT?
No, no. So the CGT is as it was in history, no matter what, like whether he changes it to your name or his name, and moving forward, whether it's in his name or your name, it's going to be under the same thing.
Right.
So that's not necessarily going to help. Yeah, unfortunately, sorry, mate. I wish I could give you a bit more there, but that's not going to make any difference. James wrote through us in question: are testamentary trusts different to other trust structures? Yes, they are different. The way the will's set up is so. For anybody who doesn't know, a testamentary trust is a trust that only comes into existence when the person dies. So my dad dies, in his will he has a testamentary trust. He could set that up for myself and my sister, one each, and it only exists when he does. They have come out saying we're going to treat it the same. If the testamentary trust already existed, we're going to let it continue into the future as if these rules didn't change. If it didn't exist, then we are going to hit it like every other trust. It's going to have a minimum 30% deduction, have 30% withholding tax. All these sort of things can happen. We've actually had a situation already where the person had died before budget night, but probate had not been granted. So we have no idea where that person's falling yet. So we have to wait till all this is passed into law, whether they're in the old system or the new system. But a lot of people are coming out now and starting to look at, is testamentary trust the right thing to be part of my will? There is talk, the government tried to say, well, you can choose it to be a discretionary, which is a family trust basically, or a fixed unit trust. Fixed unit trusts, once again, get rid of the reason for these things. So a lot of the time, discretionary trusts are really, really valuable because it protects assets from the individual. So where our clients set it up is where they don't want maybe their kids married someone they don't like, or like had a real issue with them, and they don't want a separation of marriage to be able to cause that family asset to disappear 50% to this other party. We've had some where it's drug abuse, those sorts of things. That is another reason you'd use it. So converting a testamentary trust to a fixed unit testamentary trust makes zero sense. So I think a lot of people are reassessing that. Someone, Lana, you asked me to backtrack back to the implications of inheritance tax or estate taxes. Really, really complex issues. So I don't want to go into really deep around like the legal ramifications of each structure within an estate. But what is kind of important there, and what we're going to see, what I believe is going to come out of this into future structuring, is more and more farms are going to be bought in company structures rather than the trust ones. It is easier for the intergenerational part, Lana, around that. But also, I was seeing this before the budget came out. More farmers were buying it in companies, even though the CGT implication was much, much worse. And the reason was, in a company, you're repaying it back after only paying company tax. So to give an example, you make $100,000 profit, you pay $25,000 in tax, you've got $75,000 to pay back your loan. If it's in a trust structure, you make $100,000 profit, maybe you had some other income, you might have to pay $45,000 in tax. You're left with, let's just call it 60,000 versus 75,000 to repay loans. So it was allowing people to afford to buy farms when prices had gone up because their repayments were much easier to make. So I think from a just structuring point of view, we're going to see a lot more farms moving into companies. Through and through. Around inheritance tax, estate taxes, I guess the other thing, similar link to this, and I'm sort of just ticking off all the things I want to talk about based off this question, is SMSFs for farming. We're seeing more and more of that, and this change is only going to accelerate that. I'm a bit of I don't push these. I think they're only right in very specific situations due to, I grew up on a farm. We weren't, super loaded. Cash flow could get tight. And when you have to make a payment to a super fund every month, every year, and you're going through 2 years of drought, where do you get that money from? Right? Now, the reason I look at some and go, yes, this is perfect, this is actually the best thing we can do, and I love restructuring ones in these ways, is when the key people are getting 55, up to close to 55, because you can pay that money from the farming business, and let's call it a partnership. Let's just call it $100,000 a year you have to pay in lease fees to that farm that's owned by the super fund. You put $100,000 in, the person's in retirement age, so there's no tax. They're under the 3 million cap. They've got in assets. They're in pension mode, so their income's tax free. So you put $100,000 in, you pay $100,000 expense in the business, and the business gets a $100,000 deduction, reduces its tax. That money then goes to super fund. You pay zero tax. The member is in retirement phase. They can draw it back out tax free because they're in pension phase. So now we've got the money to the individual. That individual's paid no tax on it, and the partnership, company, trust, whatever structure you're running your business from, has got a deduction. Right? The big thing for me is, can you get that money back out? And, if you're doing this when you're 40, you've got 15 years, if no government changes the rules, before you can touch it. And in farming, sometimes that's just not reasonable. But I am seeing people that are getting close to retirement starting to go and put it in to super funds. It can also be part of succession planning of how do we protect an asset for the older generation, so that even if everything goes belly up and you go bankrupt as a farming business, well, this asset, this farm is over in a super fund and it is not protected. It's got nothing secured against it. So you can get a bit of asset protection that way, plus you get that tax advantage of being able to get that income from the business to an individual tax-free and get a deduction within the business. Any questions around that?
No, that's great. Thank you.
Yeah.
I guess I'm sort of just to put it bluntly, like I'm really watching what's going on in the UK, obviously, and how they're moving towards introducing inheritance taxes and what that's doing. So, which is just detrimental. So, really trying to get ahead of the curve.
There is a little bit of it creeping in. They don't say what it is.
Yeah.
Even you look at a super fund, if a member dies, and we have a grim job as accountants trying to get people's assets out of their super fund just before they die. But if they die with the money in the super fund, there's a certain, depending on tax and tax-free components, and I won't go into there, there's up to a 17% tax on that money getting out to the children or whatever. If it goes to a husband, spouse, like if it goes to a spouse, that's fine, there's no tax. But if it goes out to adult children, there's 17% tax on your super fund wealth. Now, I think the highest one we have in our firm is 52 million in assets in there. 17% becomes quite a significant amount of money, and so that's a creeping way that death taxes are sitting in there. And they obviously they played with super funds last year, which was another thing they played around with. But yeah, that's.
Sorry, can I interject? Can I just ask you, and I'm sorry to put you on the spot, you don't need to answer this because it's more personal viewpoint than anything else. But when reading through some of the budget detail, obviously some of it's quite vague in regards to trust and inheritance tax. Do you think they're inching towards to try and replicate what's going on in the UK?
They could well do. There was a really interesting part of the budget. So when you read a budget paper, they have all the spending, the saving, everything else. Down the bottom, they have, and there's an acronym for it, I can't remember. And it was like, it's budget measures where decisions have been made but not announced. So apparently they're allowed to do that. They're allowed to make decisions, not tell you, but we're going to account for it in the budget. It was something like 48 billion of revenue. I can't remember the exact number, sorry. 48 billion of revenue that they're like, we've announced measures that are going to raise this money. We're not telling you about it yet. So, I mean, we have been scheming. What could this be? What are they going to attack next? That they're thinking they're getting this very significant number of, that is a lot of money to be extra tax revenue. Right? Well, like, where are they? What pools are left to attack? They've attacked super, they've attacked property, they've attacked businesses. Where else can they go? So I was very intrigued, and obviously I don't have an answer. I would like to call them up and find out, but there is other changes coming. We could have an election soon enough that could change things. I don't know. We've still got to get it through the Senate. I think, the Parliament shouldn't be too hard for them to get anything through, in all honesty. And the Senate, they've just got to convince the Greens. So my guess is the Greens will ask for a gas tax as part of the trying to push this through. They came out, think it was yesterday, saying they're going to try and push through the negative gearing and the CGT changes by June, and then they're going to come back to the trust changes once Parliament gets back in session, I think July, August.
George,
So-
sorry. So a lot of these changes they're implementing don't come into effect till next year. Is that right?
That is there's 30 June 2027, 30 June 2028 are for different things coming in, but
Right.
most of them come in effect from budget night.
Okay. So, but we've got a election in 2028.
Yep.
So let's say hopefully a new government's elected, can these things be undone?
Yes, they can undo it.
Right.
The government can undo it. The government supports some of the things that they've said. So not many, but they've said they support a few, not the big ones. They're not that crazy to commit political suicide yet. So they are saying they haven't explicitly said we will roll these ones back. They've sort of half mentioned it. But yeah, the first obstacle is will they get in? The second obstacle is if the government changes, will it be rolled back? My honest answer to that is I think once the revenue starts coming in, governments don't like reversing things that take revenue. They're going to go, Labor took the political hit on this. We'll take a few things back so we look like the good guys, but they're probably going to leave most of it. They're going, yeah, we're getting some more money in. That's great. Obviously I'm not a political reporter. I'm reporting here from Parliament House, but that's my rough feel of what is going to happen. Tanya, you sent a message from a CGT point of view. Could purchasing commercial property be? Someone else just put in, be a better option as an off-farm asset than a residential property? So CGT is the same across all assets with this. So CGT was the one that went broad. So it's going to be very, very similar from a CGT point of view. It's just that your year-to-year tax will be better around what you call like the negative gearing benefits. So if you're actually borrowing to buy that asset, a commercial property is going to be in a much better position. So commercial property, shares, farms, those sorts of things, anything other than residential property is going to be much more beneficial for you. Does that answer that question? Yep, perfect. Okay.
Yes. So sorry, I do have another question. I have heard that brand new housing builds might have different rules around
It most
negative
certainly
gearing.
does. Yeah. Residential property that's brand new build, they're allowing CGT is going to be the same, but negative gearing will be allowed.
On a brand new build.
Yeah, and what the legislation doesn't do, if you knock down a house and rebuild it, is that a brand new build? I'm going to guess they can say no to that. Because the whole point of that policy is they want money to be invested into new property, not old property, because they want developers to keep building so that they can try and keep up with immigration.
Yeah, I did hear that if you knock down a house and you put a duplex on it, because you've now got two on that same block of land, you'll be allowed to. But if you just knock down and start again,
Yeah,
it won't
I
be.
would,
Yeah.
I would guess wherever you heard that from is still speculation.
Yeah.
Okay.
Like it makes logical sense based on what we were just talking about. The whole thing about stimulating more property.
And sorry, I've just been involved in something like this, and I would just really recommend check your planning laws as well, because there's something involved in basically we're talking about an individual house, i.e. whether it's one big one or you're talking about a duplex will be two different deeds, if that's how it is. So it depends on the structure of the building and everything else like that, if it's considered to be one property or two.
And if it's strata titled or
Exactly.
it's titled, yeah, there's a whole bunch of fun that can happen in there. So Lauren, eligibility of workers tax offset for people who aren't employees. I don't know around sole traders. So if you have a business, if you have a farm that you're just running in your own name, but generally speaking, you have to be getting a wage to be eligible. The other sort of little trap that I've noticed, jumping back a little bit here, the 30% tax, excuse me, is in that trust, you can distribute prime production income without the 30% withholding. Okay, so that's the exemption they've come out with for agricultures, and I think it was the New South Wales Farmers Federation or the national one that fought to get that, so they did a really good job. What is in there though is it's saying anything that is not prime production income is still going to have the 30% withholding tax on it. Now, what I don't know is, like, if you have a farm management deposit, by nature, that is not prime production income, but is very, very clearly linked to your prime production activity. So we're going to have to try and figure all those sorts of things out. What does interest on your bank account? Does it have to be streamed separately? Do we have to have, withholding tax on those ones? So these are all the little things, but generally speaking, you have to excuse me. Prime production income is exempt from that 30% withholding tax.
George?
Yep.
Can you hear me? We're considering moving our land ownership from an individual into a trust.
Yep.
For two reasons. Succession.
Yep.
And then the capital gain that the land value has accumulated over the last 10 years.
Yeah.
What do you think about that?
So I'll take the second one first because it's easier. And I like easy, David. Is your capital gain, whether you're in a trust or it's held individually, is going to be the same. It's the same treatment.
I thought there wasn't a clause or whatever that it was exempt. Small business or under
small
6
business CGT concessions, yes.
Yeah.
So, but so whether it's in a trust or whether it's in an individual, you will be eligible, assuming all the rules are met around the turnover and the connected entities and a bunch of other things. If you're eligible for it in your individual name, you're eligible for it as a beneficiary of that trust.
Yeah, okay.
So you're going to be fine from that. So it's not going to make a difference to your CGT.
Yep.
The only difference it may make is if it goes into the trust and you want to distribute to more people when you do sell it one day, you can use their marginal tax rates a little bit better.
Yeah.
It gives you flexibility. So that's that. What was the first part of the question again?
Succession.
Okay. I think additionally what you did, David, is the right answer, or what you're looking to do is the right answer. I honestly wouldn't do anything until we saw the legislation, because I think maybe a structure into a company could actually work really well from succession. What state are you in, David?
New South Wales.
New South Wales trusts have like 80-year lifespans.
Yeah.
So you move it into a trust, you pass it down a generation, maybe even one more, the trust will vest and you're going to deal with massive issues on vesting of trusts. So in a company, they can go forever. You have no vesting date.
Yep.
So there is that element of it. You do have, changing. Yeah, I think I would wait if I was you and get good advice until after this legislation is passed, because I think it will make a significant difference.
Yeah, okay. Just one more trivia question.
Yep.
Before 1999, what were the CGT rules?
They were what we've gone back to, basically.
Okay.
So they were working on indexation, and then and Howard brought in the CGT discount.
Yeah, okay.
And I mean, before 86, there was no CGT, so that was a much better time to be alive. And New Zealand still doesn't have CGT.
Yeah.
So they sort of got indexation, went, maybe we went a bit greedy, bought in CGT discount, went, oh, that's really messed up the housing market, let's try and rip it off. But by giving it to us for this period, it's distorted everything, and people have made decisions based on the policies, and now they've just out of nowhere gone and changed it. One of the things that pissed me off the most about this was Jim Chalmers was getting interviewed after the budget by Sarah Ferguson, and he said, look, we only decided on this 2 to 3 weeks ago. Mate, this is like one of the biggest changes in Australian tax policy ever. It's impacting literally almost every Australian. And you're like, we haven't thought it through. Just let us off with this one, would you? Like that's ridiculous. And it shows in their policy. I'm sure they had Treasury model it out, they did all sorts of things, but it is so badly done. Whether you believe it was the right or the wrong thing, the way they've executed is shocking. It's the worst I've ever seen from a way they've executed it. It is going to cause complexity. Already the structures we're trying to think of to get around all of these things, they're just going to add more complexity. And like the whole thing about Australian tax system is it's too complex already, right? Why would you make it more complex? So, I mean, they've got those issues. I think I saw a thing the other day of the developed countries. Australia now has the highest CGT of any of them. Like it's ridiculous. I've already had not farming clients yet. I've had some other clients, especially in the tech space, who are, I mean, the budget's been out, not even a week? And I've had probably 3 phone calls of people being like, okay, what are the countries other people move to? So it's like they're legitimately thinking that way. They're at the early stage. They're like, I can pack up my family and I can go for 6 years, and I'm going to be, if this goes well, $5 million off better in hand. I'll take $1 million a year to live somewhere else. And that can be New Zealand has some tax rules that are not bad. It can be, into the Caymans. People go to Dubai, Singapore. There's a whole heap of places that those countries are going to go. Now, we're not going to get the employment from that in Australia. We're not going to have people working for us. We're not going to have people paying tax. Even the employees who maybe get options in that company, they're not paying tax in Australia. So it's pretty ridiculous what they've done. All right. I think those are the key things.
George, just
I sort of had.
there's
Yeah.
one question from Stacey. She's posted it up twice there.
Oh, yeah, sorry.
Is there any benefit for someone to pass their farm onto a grandchild directly, or are they better off passing to their
Child.
who
Who
then
then
transfers
transfers.
to the child in the future?
Sorry, Stacey, I missed it. I would say that is very much a family dynamics question. From a tax point of view, it's not looking like it'll make a huge difference, only because of the intergenerational benefits of transfer. It would probably be simpler to send it straight to the grandchild, as in you only have to do one transfer, so you're spreading out your transfers. Stacey, if you can, what structure is that farm in would make a big difference to that question as well.
She's in a partnership.
Yeah, partnership. Okay. So with a partnership, you are going to have some exemptions around the stock. You're going to have an exemption around the plant and machineries. And, if it passes on under a will, you're not going to have a realisation of CGT event. There's no major tax in there, Stacey. What probably you're in the middle, so that's the interesting one, because some people would feel slighted by that. What you've got to think about is if that's not in your name, Stacey, depending on the debt level on it and those sorts of things, and you want to borrow or use it to invest or secure it against it for something, it's not going to be in your name. So a lot of people don't like that because they're like, okay, well, I've got an asset now that's maybe fully unencumbered, and I want to use 20% of that equity security to go and buy some shares or an equity or things so that I do have that off-farm income. Then you don't have those options. And as the 45-year-old, I'm guessing the child's sort of coming of age. They're there, so they're going to be on their marginal tax rates. So tax-wise, it's not going to make a huge difference, but from your financial world, not having ownership of that asset is going to maybe set you back a little. Okay, Lana, you're getting creative. I like it. Nothing like a good creative accountant sitting there. So gifting, firstly, in Australia there is no tax. You can gift as much as you want. If you had $1 million sitting in your bank account, you can give it to someone. There's no issues. Where there is issues, if you transfer assets, then the ATO replace it with a market value rule. So it doesn't get you around capital gains tax. So super funds, if you're of a certain age, you can just take that money out. That's yours. There's nothing you need to worry about there. Take the money out, give it to someone. Generally speaking, my clients like to leave it in because it's any earnings you get in there in retirement phases at a 0% tax rate. So think of that as your own private little Cayman Islands. So super funds, we generally, I made a joke about accountants being a bit grim before, and we literally, we sometimes a week before someone dies, we get the money out of super funds so they're not paying a death tax. But up until that final sort of point, it's an effective vehicle to hold it in. I'm just checking if there's anything else here in the question.
Sorry, can I just ask a question there as well? So basically you're saying that it's the property, for example, is the tax is based on current rate. In light of all the issues that are going on with compulsory acquisition of properties, and the Greens are continually rezoning properties as well.
Yeah.
Again, personal speculation. Do you think there's going to be a push from the Greens to rezone a lot of this? I mean, it's not going to be any financial benefit to them, but it will certainly save a lot of agricultural land.
Yeah. I have no idea what they'll do. They're in a real position of power for the first time in a while, because they in the Senate have basically enough to get the majority by themselves. So if the government gets them across the line, they get all of this across the line. So a Greens agenda is a strong one at the moment. maybe they'll look at some of the biosecurity stuff and say, stop being idiots. I don't know. We just have to keep watching for that one. Jess Spence, just seeing here your one, prime production income's pretty firm definition. Yep, it does. My hesitation around saying anything too much on this is the way the government seems to have done this round of budget changes is like, here's this, and we're changing the rule for this. And an example of that is the trusts. They've come out and said, look, we're attacking trusts, but we'll let you change it with no tax implications and you can roll it into a company, which, traditionally you could not do without these other implications. They haven't thought about the state taxes, I don't think, because if you try and do that in Queensland, you're transferring a business. There's actually duty issues, and each state will have their own sort of duty issues. I know Western Australia's got it as well. So, I think there will be issues. What will happen? So say in a trust there is prime production income. It's clearly you're selling some wheat, and then there's some off-farm income coming in as well. You'll be able to distribute the prime production stuff, no withholding tax, and then we will have to calculate out the 30% on all the other stuff. Now, what exactly is non-prime production income? I know it's pretty clear at the moment, but I'm not clear in the way they will treat it if you have farming income within that trust.
So, George.
Yep.
Question. So, if you get a lease payment, are we going to get taxed at a higher rate than that? Then, because nothing's going back into the primary producers, nothing's going back into the land. We're not upgrading machinery. We're not upgrading everything. We're just purely getting that. It goes into the trust for our 3 children. We pay for their boarding school from that. How are we going to be taxed? And are they going to be? Are my children going to be affected by this when they turn 18? Because they're going to get a group certificate saying they've earned this money from the trust, but it paid for their schooling. And every bit of lease money that we get goes into our kids. It doesn't go back into the farm. So have we shot ourselves in the foot by not doing that, by improving things like fencing and maybe buying a tractor just for the, the 10 acres that we've got with the house on it? Have we shot ourselves in the foot by doing that?
Peter, 10 acres, first we have to say, is that actually prime production land? Like there is some tests around that?
Yeah, no. We own 600 acres and we lease that out. But the house on its own has just got the 10 acres on that. So should we have bought machinery for that little 10 acres? Because everything we get is pure profit.
Yeah, and let's separate out whether there's machinery or anything, because I don't think that would help you.
Right.
At this point. The nature of the income is passive.
Yeah.
And when it moves from being active income, running a farm, to being passive, it is more likely to be taxed with that 30% withholding tax. So have you shot yourself in the foot? No, that can change. It could be, you could be adjusting, you could do some different things like, that can change into the future because it's not a fixed thing, you might have a lease term, I understand that. But people seem to find ways to rework these things. The thing is, will it cost you more tax?
Yes.
If you're paying people out of there that are on less than 180 grand, yes, it will. It'll be a higher tax rate than before the budget.
Okay. Yeah. Understand.
Yep. Perfect. All right. Do we have any other questions in here? Yeah, Kayla, if you're currently in a trust, should we consider moving to a company? And my answer to that is yes, consider. And consider that once the legislation is passed. Once the legislation is passed, I'm more than happy to jump back on here and run through facts rather than speculation. Know it's an option and know that maybe it's something that you should do. Don't pull the trigger early. A lot of people go and make knee-jerk reactions before they know the end result. This could be incredibly watered down by the end of it. I don't know. We just recently had, there's a Vision 296, which has got to do superannuation, and it was massive. They were going to tax unrealised gains. It was wild. We had multiple webinars at Prime on it. We were running through our clients. We're having multiple calls. It was completely irrelevant, all of that work we did, because by the time the legislation passed, they got rid of that clause. Right? So do remember it is not in legislation yet, but if it does pass like this, I would say a good chunk of people are going to be restructuring. It will depend on their personal situations. I've got some clients I know definitely we will not restructure them, and I know some that if it does pass, we will most definitely restructure them.
George, I have a question for you, perhaps off the back of the concept that it's not fixed until it's passed in legislation.
Yep.
Do you think there's much chance of lobbying changing the outcome of this at all? And if so, how do we lean into that? Who should we be talking to and asking for help?
I mean, just get Steph to do a post. That should do it.
Yeah, love that.
That'll sort it out. So look, the Farmers Federation did a good job of pre-lobbying. So I would say they will be in that space. The startup industry is doing a really good job off the bat here. They are getting a lot of social media attention, and that does influence into the the views of everybody in Parliament. So I think your bodies at this point. Do I think your bodies are doing an excellent job? That is a very different question there. Like, I think in some ways they're hopeless, right? I'm giving them credit. They did make some pre-work here. I think as an industry, there needs to be a rallying point outside of these lobbies. It will happen over time. Out of somewhere, people will rise, and you'll suddenly see there will be a group created. I see it happen a lot around the power, the wind, the turbines. You'll start to see someone take leadership in this space, and it mightn't be this year, but it will start to happen. And I think get behind those people. Existing negative gear properties should be able to continue to negative gear, right? And when they're considering existing negative gear reform. Yes, that is right, Chloe. Negative gearing, and remember, negative gearing's only got to do with residential property that's not new build. It is going to be able to, if at budget night, so that's the day you're looking at, it was already negatively geared, then you're good to go. It can continue. And that's where a lot of our clients are working with our brokers, not our brokers that we know, that to get it onto interest only, because they're like, you know what, I don't want this capital like going down. I want to keep the negative gearing for the next 30 years because I'm not going to be able to do this again. This is my one shot at it. The other thing which is interesting, once again, not in legislation, but one of the ministers came out and said, if you own a home and you now move in like a year's time and it still has a debt on it, and you start renting it out, that will be able to be negatively geared.
So how did they draw the line in the sand of budget night last Tuesday between then and end of financial year to say it was negatively geared then or not?
Our system, Chloe, is a self-assessed system. If they ever come and look, was it rented? Like, was it available for rent as at that date? I think the first thing they'll look at is, was it rented the year before? Right? If they're going to go and do data matching, which they do more and more of now, they're going to say, was it rented the year before? Did it suddenly just come in this year? And away you go. Then that probably won't be a trigger for them to look, but it'll be the first start of an indication. Yeah. But at the end of the day, a self-assessed system, I've seen some pretty wild things put through tax returns. So like I pick it up, I'm like, oh, that is not legal. But they got away with it some of the time, so good on them.
I've got a question, George.
Yep.
So in our circumstance, so farmers from Narrabri, so and we've just been through family succession and got a recently new family trust. So our cost base is recent, but we're likely going to have a biodiversity sale of portion over the land, which will be a lump sum, maybe next financial year, perhaps the financial year after that. What are the implications there for CGT and income distribution and things like that?
That's a good one. As part of your restructure, was there a resetting of cost base, or was it just? I'm assuming it was.
Yes. Yeah.
Yeah. So look, you'll be paying the gains on the difference. So then you'll have a new reset cost base, and if you're selling some off for biodiversity reasons, if you're actually selling that portion of the land, then there will be CGT on that. It will be.
No, the trust will still own the land, but
So it's just being locked up under the biodiversity stuff.
Yeah, that's right. Yeah.
Okay, that will be income. They have not thought this through, so I cannot answer whether that is going to be a prone production income or whether that is going to be a passive income, because there's a chance that's held in a trust, that's a passive income, and they're going to have a 30% tax withhold on that. Just thinking logically, it is not income that you have to work for. It is like a rent or a lease. So my guess, and it's purely a guess, sorry, Rodney, I can't give you much more than that, but my educated guess on that is it will be passive income and therefore subject to the 30% withholding tax under the trust.
Yeah, okay. And so those rules will only change in July 2027, or will it?
They're giving July 2027 is when, yeah, I think, sorry, there's 3 main dates, and I think the trust 30% does come in then. Yeah.
Yeah, okay. Thank you.
Yeah. Okay, let's have a look at a couple of these questions. Thanks for asking questions, guys. Yeah, I actually appreciate it. Stacey, transferring intergenerationally and CGT, there is capital gains tax on interfamily intergenerational changes, unlike some of the other stamp duty exemptions and those sorts of things. Depending on the size and the scale, though, quite often, if it's it's eligible for the small business CGT concessions, has been held for 15 years, or you can use the retirement exemption, depending where your family's sitting from a tax point of view. You can get it done in a tax effective way. If the older generation is already 55, 60, you can normally do it without too much capital gains tax, depending on how long the property's been held, those sorts of things. So yes, there is tax, but quite often we can mitigate down to lower or zero. Yep, James, you're talking about exactly what I was just talking about. You previously sold a property, rather than paying capital gains tax, you were able to roll it over into the new large value and the land size purchase. Will that still be an option? Yes, that is part of the CGT concessions that we were just talking about. That will still be an option, assuming, back then, James, you were eligible. I'm going to assume you're still eligible. Yes, that will still be an option. You can keep doing that multiple times. Okay, come on, thank you. Yep. Okay. Looks like people have had enough of me. People are trying to go have a feed, or get the kids to bed. I mean, I'm surprised people last this long talking to me. Normally, when they're talking to accountants, they leave pretty quickly.
You're a fun accountant,
Mate,
George.
very, very, very
Very
compelling.
insightful. Thank you.
Before we go, has anybody else got a question on that? No. If anything pops up, Steph and Josh have got my details. I'm more than happy to answer questions. I want to help out, so feel free to get those details, and we'll fling them on through.
You've just answered my husband's question so much. He's sitting in the background going, got it, got it, got it.
Good.
That's so good.
Thanks, Steph and Josh. It's absolutely awesome. Thank you so much.
No worries, Peter. Just
Hey.
guys, quickly, the regarding this, there will be a follow-up email. Okay, so that will go out to you with recordings, some notes and bits and pieces like that. So just for your information, there'll also be a bit of a thing regarding George and his details as well, if you want to follow up with anything else regarding this.
Yeah, that's what my husband just said. Where?
Yeah.
Thank
Where is
you. Very
Where
good.
is Prime Partners, George?
It's Orange and Sydney.
There you go.
Cool. Thank you very much, everybody, for being here. We really appreciate everyone asking questions. It's awesome.
Yeah.
Thanks again, and thanks so much, George, for your time.
Right. See you later, guys.
Super, super valuable. Okay, guys, thank you so much. Have a great rest of your night.